Hey, folks, welcome. It is my great pleasure to welcome you to another fantastic interview, not because of me, but because of the guest, Larry McDonald. But first, just for both Larry and my sake, we're putting up a quick disclaimer that just says this is for educational and informational purposes only, yada, yada, yada. You guys can read it at your discretion, but this is saying that neither Larry or I am your personal financial advisors. You could perhaps speak to Larry about becoming that, but we're just having a good conversation. And this is for educational and informational purposes only. And with that said, hey, folks, great to be with you. What a week, Larry. I mean, you know, oh, it's there were certainly a lot more highs this week than lows. And I'm not just a bull. You know, people will always say, oh, John's just a perma bull. But on the other hand, I think like a lot of us, just getting depressed, Larry, over all the people that are out of work,
Yeah.
even if it's temporary, the people that are losing jobs and when those jobs come back, the people that are sick, the families that are grieving, all of that. It's like, all of this stuff just comes down on us. But on the other hand, you look outside on a sunny day and you're saying, no, the world isn't done yet. That, this might be a tough time we're going through, but how does the song go, Lair, or the expression, if you're going through hell, keep on going?
Well, Willie Nelson always said, he said, it wasn't until I counted all my blessings each day that my whole life turned around. And that was Willie Nelson. And I think that when you're going through something like this, counting the little things, the blessings, really every day as a habit gets you through this. And we're going to come out of this. I think by the end of the year, fourth quarter, we're going to look back as, kind of a bad dream.
Yep, I happen to agree. And I'm certainly hoping that that's the way this is going to play out, Larry. Um, One of the things I told, by the way, folks, if you want to follow Larry on Twitter, in case you don't already, it's @convert bond. @convert bond is his Twitter handle, and lots of great information. And because of what he's been doing, he's on with everybody. He's on with my friend Tom Keene and John Farrow. By the way, what do you think of John Farrow? Isn't he just the best?
He's doing great. He's a
Yeah,
rocket ship right now. And you know
yeah,
what's happening with financial television is you're getting institutional quality talent that's moving into some of these shows. And he's right off an institutional trading desk with some of his calls and analysis. I think he's doing a great job.
I agree. And I enjoy how he and Tom spar against each other,
Yeah.
Larry. In case you guys haven't watched or listened to it, they're on Bloomberg Surveillance in the morning. I think it's 7 till 9 with those two, and then Lisa Abramowitz is on there with them. And they've got a great lineup though, because Tom is this curmudgeon-y, funny, smart guy, and Jonathan Farrow is just, you know, he's like a guy that would be on the trading desk with you, Larry, because
Yeah.
he's a
Yeah.
guy that really understands bonds and FX,
Yes.
foreign exchange trading, and he's pretty serious most of the time. So you must have a gas whenever you're in with those guys.
Yeah, they're great. And what I did when the book came out, I met you in 2009 when the book was coming out. You were really great, and you helped me. I'm so grateful to you. And we built a wonderful friendship since 2009, launching the book. So the book's now in 12 languages. It's a New York Times bestseller, and I tell my wife once a month, as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock.
Wow. Well, and maybe give everybody, Larry, if you wouldn't mind, just a several minute resume of, because this guy, folks, was there as Lehman, both as Lehman was zooming and as they were one of the preeminent investment banks on the planet. And then as it all came down, maybe if you could give them a little background for what you had been doing with Lehman until it imploded, Larry, that would be great.
Well, there's no I in team, and I was blessed to be part of a great team. Mike Gelban was our boss, and Mike has gone on. He just launched Exodus Point, $16 billion of demand hedge fund, largest launch ever. They basically had 16 billion of demand for his fund. They launched it with 8 billion. It's the largest launch of any hedge fund ever. And Mike was an inspiration at Lehman because there were a group of people that were trying to stop the madness. One by one by one, they were silenced. I mean, at Lehman Brothers, you kept your head down, you did your job, or you lost both. It was one of those situations. And Mike, that team, they pushed out a lot of the talent in 2007, 8. It pushed out a lot of the talent. And then after they did a management change in the summer, and they brought Mike Gelban back. So I was blessed to really be part of that team. And over the years, back then I ran our distressed business. So we look at how the credit markets impact the equity markets. And what happens in markets like this, as you were describing this morning, is there's, correlation starts to move between asset classes, and you can get phenomenal leading indicators by looking across the asset classes. Whereas in a bull market like 2013, where the market's going straight up, or 2017, cross asset analysis, it doesn't really matter that much, because all you have to be long are the FANG stocks or equities. But what happens is, as financial stresses rise, as what we call financial conditions start to stress, and we have our 21 Lehman systemic risk indicators. What happens is, through that period, through January, February, and March, cross asset analysis can give you phenomenal, both bullish leading indicators and bearish leading indicators, which we've had over the last month. They've been extremely helpful to our clients. We have a Bloomberg chat with over 400 institutions live every day. It's all institutional investors, mutual funds, pension funds, trading desks around the world. And we are conversing with the different funds in a cross asset allocation analysis, in terms of what are the leading indicators and what are the lagging indicators.
Well, there, maybe, so part of this 400 person cabal that is back and forth on the Bloomberg, what about the bear traps? I mean, you write this newsletter. I know thousands of folks subscribe to that. And does that let them into this Bloomberg chat as well, if they're a subscriber to that?
Yeah, that was the whole goal. I mean, years ago when I started out in the 90s, late 80s, 90s, I was a financial advisor, and I always felt like I was a little bit out of touch with the markets, because a lot of these financial advisors, they work in beautiful places like California, Carlsbad, Newport Beach. I was on Cape Cod in the late 80s, early 90s. And so we built the bear traps as a connectivity between the institutional side and the retail side. So if you're a financial advisor or a family office, high net worth person, we will send you kind of a recap of what the institutions were doing, what they were looking at during the day. So if you're out with clients, or you're up on the ski slopes or in the south of France, then on that morning, the next morning, you can get a breakdown as to what the hedge funds, what the pension funds, what the institutional investors were talking about during the day, and where's the next trade, where's the best risk reward at this moment.
Right, and I have found that the notes I get from Larry folks are, notes you won't get anywhere else about what's going on with things like that, with global economic outlook, emerging markets, the sort of smart talk that you get from that Bear Traps newsletter is phenomenal. So again, kudos to you, Larry, for that. Let me ask you a little bit about, if you see, I'm not saying you would, but if you're welcome. Do you see some similarities between either the COVID-19 crash that we've witnessed and that we're still feeling, or is this completely different and so different that you can't even compare it to any prior crisis that you've been through?
Well, there's definitely some similarities. That I've read historically through my career about the sudden stop economics, and Lehman was close to a sudden stop, but it really wasn't a full sudden stop. This thing is a sudden stop, and it's in a lot of ways worse than Lehman in the sense that the initial shock affects more people. It's hard to believe, but it's actually affecting more people at the same time. This sudden shock is just, I mean, breathtaking, spine chilling. And when Lehman went down, it created a shock, but there was still, you could still go to a Broadway show. You could still go to a nice trip to Hawaii with your family, or or if you were struggling going through a bad time, you could still go see a loved one, or spend time with family members around the country. But now, this is very different. But the good news is, our 21 Lehman systemic risk indicators, in some ways, are lower than they were during the Lehman crisis now. What the Fed and the SEC and the regulators have done around the stress test of the banks, I mean, thank God they have built these banks to a fortress balance sheet, as Jamie Dimon likes to say. And if you look at the credit default swaps and the curve, so the 1-year paper versus, say, the 5-10-year paper, what happens is when a bank gets stressed, a lot of times the curve will start to flatten. And what we do at the Bear Traps, we measure that flatness of the curve, because the more flat the curve is, the higher the probability of default. And we're looking at all the top 50 banks in the world, and it's fascinating that the credit risk tightness in the financial space is much lower than Lehman, and it's in some ways it's a little bit lower than the 2011 debacle when we downgraded the United States. Greece had a default, and there were a lot of banks that owned Greek paper, and so that created a real huge drawdown. The summer of 2011, it was a lot like this time, but the banking system today is much stronger, and that's probably the brightest part of this latest movement in the markets.
Well, since you're talking about banks, Larry, let me pull up. Larry sent me some slides, folks. So I want to share one of them with you right now, which is his. There, it should be up there now, Larry. This is the 5-year CDS, the cost of default protection with J.P. Morgan, and this goes back through 2014 on the far left side of the graph, folks. Comes all the way across to right where we are now, and look at that spike. I mean, according to what I'm looking at, Larry, it looked like it spiked up to 170 or thereabouts after being at maybe 30 or thereabouts just for the last, it looks like JP Morgan in particular was down in the basically between 40 and 30 for the most of 2019 into 2020.
Yeah, what the Fed has done here is really awful in this regard. They launched this repo facility in September, and every analyst on the street said this is a liquidity-driven rally, don't fight the Fed. So credit spreads tightened through the top, literally through the tightest levels, or right on them. And so bonds were so tight. In other words, low yields, high bond prices, and then we got hit with this black swan with the coronavirus, and it just literally created this vicious spike. But what's amazing about this is, I'm sorry the chart doesn't go back further, but this spread right here, although it looks bad on the chart, it's much tighter than the Lehman credit default risk, and it's in many of the banks are tighter than they were in terms of the cost of default protection is less than 2011. But the reason why I put this up here is, to me, this is fascinating because HSBC has the most exposure to China. And one important takeaway for the viewers is China and Europe went into this first. They're going to come out first. And the US went in last. We're going to come out last. It's the complete opposite of 2008. In 2008, the entire world, the US went into the crisis first and came out first. And this time, the US is going to go in last and come out last. That's a real dollar negative. And the stimulus, there's about 5 to 7 trillion of stimulus coming out of all of the developed markets, including China and including Europe and the United States, and all the big central banks and governments now are fiscaling up. Germany, we've been lectured for years, John, years. I've been at so many different conferences where people said, Germany would never fiscal up. Black zero is considered the financial austerity discipline in Germany. Germany is going to spend almost 25% of GDP. That's incredible. So here's what's going to happen. All this stimulus is going to ooze, around the world this year, and commodities by the third, fourth quarter are going to be up meaningfully. Commodity equities, so your copper names, your steel names, we're overweight these names. They're already down 60, 70, 80% from the highs in a grizzly bear market before the coronavirus. And so bottom line is you get a weaker dollar as we head toward the election. As you can see in that last chart, the main point of that chart is that there's much more financial stress in the US now relative to Asia, HSBC, default protection. You see that purple line there. That is, look at that. That is incredible. HSBC default protection is much tighter, lower cost of default protection than the 2015-16 China deval. So here we are in the midst of one of the greatest economic shocks, and Asian banks' credit risk is lower than it was during the 2015-16 China deval and the oil crisis then. So bottom line is, what this tells you is we're going to have a big renaissance, economic revival through the next couple of quarters internationally. The U.S. is going to be catching up and slowing down. It's really good for commodities. It's really good for spaces that capitalize on a weaker dollar.
Wow, that's very interesting insight just right there, Larry. Based on that, and it is pretty amazing too that HSBC, that the cost of that protection, the 5-year CDS was so much less than JP. I'm stunned that that's the case. But as we always like to say, Larry, I follow the smart money and the big money. So there could easily be really big money folks chasing into any of these banks. And to see them saying there is more risk, at least over the last little bit here. Now they're probably gonna pull back, folks, as you've already seen on the chart here. It's coming down, the JP Morgan cost of that credit default coming down pretty dramatically. It's already down from what, 170 to 97 or something like that, which is, almost half of what it was just days ago, but still way above, 30 points above where the HSBC number is, which is 65.40 or thereabouts, it looks like there.
Yep.
Now, go ahead.
Well, one important thing for the viewers is, in markets like this, credit leads equities. So if you think of equity investors are just one group. There's different groups, and each group has access to different information. And what we saw in late February, and we were quoted, very fortunate, we were quoted as the team in the Financial Times by Gillian Tett on February 20th. And the quote was, our Lehman indicators, our systemic risk indicators are pointing to a Lehman type drawdown in the near term. So we were quoted before the big drop, we were quoted in the Financial Times pointing at rising systemic risk. And what we noticed back then was credit started to break down in late. A lot of the oil names were in stress, even some of the airlines. Late February, there was a massive divergence, whereas the S&P and the NASDAQ and the FANGs were ripping to new all-time highs. But across consumers and credit, like I said, the oil space, airlines, and just high yield in general was rolling over. And that was a remarkable leading risk indicator. Our 21 Lehman systemic risk indicator gave a really good call there. We got clients long volatility, paid off nicely. But what's interesting about it today, that's the past. You're only as good as your next trade. But this week, what we saw Friday, Monday, Tuesday, was the credit was dramatically out. For the first time in a long time, credit was not underperforming, because like I said, in late February, credit was underperforming the equities. So equities were at all-time high, credit was rolling over. Now, this week, it gave a buy signal for US equities where credit started to outperform the US equities, and that was a buy signal for stocks, just, for a trading buy.
Now, when we had Tony Dwyer on earlier in the week, Larry, and Tony was saying, and on Monday, he very accurately called, he said, look, this felt like the panic last week. And he said, you get a panic, then you get a relief rally, then you do some sort of retracement. Obviously today, they were in the midst of that retracement, even as the House, Larry, was approving the bill that went 96 zip through the Senate, and then passing it on to the president. But the algos and everything else more or less said, you know what, 17%, too much, too fast. At V like this, we're going to shave some off of that. Maybe we don't go down and test the lows, but we're going to knock it. And they knocked it pretty hard right into the close today.
Oh, we sold off hard into the close? Go. That's too bad. Well, yeah. Well, and Tony's right. I mean, when you move that far too fast, and most people by now have seen the stop. I mean, all the statistics, but the 3 days of this week were the biggest 3 days since 1931. It's not great when you see those, big moves. You want to see a natural bottom, not a sugar high. We're still in the kind of the sugar high environment.
Now, I know you have another slide that you might want me to pop up here. Let's see, the Saudi CDS, because, there were so many punches coming in, Larry, from all over. And one of the big punches was, of course, coronavirus. And then us having to basically shut the economy down while we forced people to distance themselves from groups. At the same time, all of a sudden you get a shock like this with something you're also very familiar with, because you go over to the Middle East and speak all the time. But all of a sudden MBS comes in and he hits Russia. He goes after Putin and says, okay, you want to play that game? I'm going to pump all I've got. So tell us a little bit about your reaction to that, and I'll pull up that slide.
Well, this is so important because I think the Saudi CDS is going to be a great leading indicator, because if you look at the timeline, when MBS decided to throw that punch, we were not quite at the peak nowhere near the peak of the terror of coronavirus. So there's a very high likelihood that the Saudis miscalculated and they threw a punch. They probably underestimated the demand destruction that's taking place in this lockdown globally. And the Saudis in 2016, you see that CDS 2015-16. You see the CDS, how it reached 250 bips there, the yellow line on the left side. This is so important. because Saudis in 2015, 16, they were burning like 65 billion a month. Uh, that's a lot of money, a lot of cash burn. I mean, if you're a young couple in Saudi Arabia and you get married, you get a check for like $30,000 from the government. I mean, this is a very catered society with a very high cash burn, and their foreign currency reserves are about 450 billion. Now, street estimates say they're burning now 100 to 200 billion a year, but keep in mind that's not taking into consideration the financial stress. We've heard in recent weeks, this week, that they're trying to pull their money from a number of hedge funds. There's a rumor going around the street they're trying to pull their money from SoftBank. There's all kinds of financial stresses going on behind the scenes, where the Saudis, they threw this punch at Putin. They have a cash burn problem that is much more severe than they probably thought when they were winding up and throwing the punch. So the credit risk of Saudi Arabia, if you look back to 2016, it was a great leading indicator, because if you remember, the same thing kind of happened. They didn't throw a punch at MBS, but in 2016, they threw a punch at the US shale complex. And that punch really was unsustainable, because once again, the cash burn caught up with them and they had to pull back on their threats. And I think it's very similar to today. They're burning so much cash. I don't think they can go on much more than another 2 months, maybe 3. And the market's going to figure this out. Remember, the market will figure this out before they cave. And I just think that if you just look at the airlines, if you look at passenger travel down 92% across all U.S. airlines, global airlines, the punch that he threw MBS into Putin they didn't do this math, and they're going to have to back away. But the best leading indicator in the world is going to be the CDS of Saudi Arabia, because hedge funds, asset managers, they're doing the math. They're all measuring the cash burn. And as you can see there, as that CDS, it went through the 2016 levels. The higher that CDS goes, the closer you are to a Putin MBS truce. And that will give the energy space a colossal kind of mean reversion. And we could see that in the second, third, fourth quarter. Also, watch the rig count. The rig count in the Permian, and Jim Cramer's great with this. He's looking at the rig count every morning. We were already down 30, 40, 50%. We're going to be down another 30, 40, 50% in terms of the rigs. The production that's coming out of the U.S. is going to be down 60, 70%. So we could have a situation in the fourth quarter where we have this $5 or $6 trillion of stimulus oozing around the planet Earth. Planes are going back in the sky. Trucks are back on the roads. People are back at work. And because they've taken so much production offline, we could have a shortage of oil in that third, fourth quarter with a vicious pop. So we're very bullish on the energy space as a whole, buying high quality names that are not levered, the XLE type names, especially in the commodity space, in the copper names as well. Copper and oil, we see a real big third, fourth quarter mean reversion.
Well, what I love about this, I love the way you explained it, Larry, but I also love juxtaposing these 5-year CDSs to the JP Morgan chart that we had up just before this, because it gives you an idea. When this thing spiked, and the BP oil and gas 5-year, as well as the Saudi, both of them went up over 300. It looks like the BP oil and gas 5-year CDS spiked above 350, which is almost double the spike that we saw in JP Morgan, which is pretty darn amazing. And then Saudi Arabia, the country's credit default swaps going up over 300, even if they've pulled back down here now to 163. That's still crazy. So I agree. I think this is going to be one I'm going to keep on my my machines here, Lair, to see when, like you say, when we get this, when that spike stays up, and MBS decides, we can't take the heat anymore. We gotta, smoke the peace pipe with Putin. I think that thing is the oil stocks are gonna rock on that.
Yeah, and the one wild card is the election. Trump, Trump wants a weaker dollar. We think there's a very high probability of a dollar intervention. The dollar has been a global wrecking ball the last 6 years. If you just do the math, the amount of trade that's in dollars, right now there's 13 to 15 trillion of dollar denominated debt on the planet Earth. So when you and I were younger, in the 80s and 90s, when the dollar made a big move up, there wasn't as much dollar denominated debt in the world, and there wasn't the same amount. The dollar volume of trade in dollars is very high, and there's a lot of global trade in dollars coming out of between China and the emerging markets. Remember, China's currency is pegged to dollars. So what's happening is there's a lot of systemic risk tied to the dollar. So there's a very high incentive for the U.S. Treasury, Bank of England, Bank of Japan, PBOC. There's a very high incentive for these guys to contain the dollar, because the dollar, in any kind of risk-off event that we've seen the last 100 years, there's always this flight to quality, right? And people want to own dollars. That's great. The U.S. is the strongest currency and country in the world. But now, because of all that dollar-denominated debt in emerging markets and around the world, and because of all the trade that's in dollars, it creates a vicious multiplier, or negative multi-GDP. Remember, there's 64 trillion of GDP outside the United States and 18 in. Always remember that, 18, 19, 20. So US is, say, 19 trillion of GDP. There's 64 trillion outside. A lot of that trade. So when that dollar makes a big move, it's a real GDP's destruction vehicle. And we know Trump, the Rust Belt state, Michigan, Wisconsin, Pennsylvania, that's really, and he wants a weaker dollar heading toward that election. That would really stabilize things for his manufacturing base, which is in some trouble now. So you want to be thinking about dollar for 2020 for that second, third, fourth quarter, and that's the playbook we're putting together.
Cool. Well, let me throw a different one up here, Lair, just to get your comments on this. Let me see. I just got to flip to a different slide here. Oh, here it is. So just give me 1 sec. I'm going to share this one. All right, okay, this one's going up there. There you go. So
I like that.
I'm going to be talking about this one tomorrow with a chart summit, a bunch of JC Perrette. Do you know JC?
Oh, yeah.
And his team? Good guys.
JC's fantastic.
Yep, I agree. And we're going to talk tomorrow about a whole bunch of, I think they've got probably 20 presenters or something. It's free, and it should be a great conversation. But this one I like, Larry, because what I did here was I grabbed these sell-offs, and I wanted something more than just, a random little sell-off. Some of these are black swan kind of events and how the markets reacted. Number one, how big was the sell-off? Number two, the duration, how fast, because we've all heard that this is one of the fastest in history, one of the fastest sell-offs in history. And then, okay, what about the duration? How long from the time we smash down to whatever the bottom is? I happen to think, Larry, we got really close, and maybe we retest, maybe we don't. Again, I cite Tony Dwyer with the the panic whoosh to the downside, which was a spike in vol, and we got right to the edge of that 95th percentile in volatility. And then we saw this whoosh to the upside. That's the relief rally. And then the question is, how much of a drawdown do we get as the market goes back to work? Now, by the way, during this broadcast, folks, the president did just sign the bill that the Senate passed and then the House passed today, Friday, and handed it over to the president. He just signed that, Larry, like 20
Wow.
minutes ago.
What a moment.
Yeah, he didn't waste any time. But when you look at these, so some of the really big ones, the global financial crisis, which is why it's so cool to have you on here, Larry, 57%. A lot of us remember seeing, I think March 6th or March 9th, whatever it was, Larry, of 2009, we bottomed at 666 in the S&P. That was the bottom, a 56% drawdown from where we were to where we got to during that time. And then the duration of that sell-off, because it kicked off in 2007. And then obviously early 2008, Bear Stearns had their issue in March, I think, when they got purchased because, they had their liquidity crisis. And then it rolled into September when Lehman had theirs and just kept moving to the downside. As you see, that's why the duration of that one was the longest sell-off. And it took us 1,022 days to recover. So in other words, 3 years to recover. You look at some of these others, like even Black Monday, that was 5 days, 5 days for that thing to go 28%. We just did, 30% in 19 days. So it's not the fastest ever. A lot of people were citing that saying fastest ever. Nope, not the fastest ever, but pretty damn ugly. And the question is, do we get to accelerate the recovery at all, Larry? Or is the recovery process because there's, psychological damage done to investors and so forth? I want to hear your take, and then I'm going to tell you mine on that.
So what you're getting at is very important. And we have a blog coming out, and I'll reference you on this. Event-driven sell-offs versus secular and cyclical sell-offs. And this is what this is getting at. And if you look back, I can send you some of the data. Some of the data is right here. But if you look back over the last 100 years, event-driven sell-offs, which are sudden stop type shocks, are much shorter duration than cyclical secular trend changes. I mean, the Lehman thing was just a massive buildup of leverage, a weakening economy through 2007, 8, and just a credit bust. Whereas this, I'll tell you a fascinating thing. I was looking at this week. I was on Maria Bartiromo's show on Fox, and Maria and I were talking before the show, and she said, Larry, what were the jobless claims right before Lehman versus now? And I said, that's a great observation. And guess what? The jobless claims right before Lehman were close to 600,000, 550. And the jobless claims before this event were like 210,000. So, of course, we did 3 million this week, which is a tragedy. And it's one of the worst. It's the worst number of all times in terms of jobless claims. But it just goes to show what you're talking about, event-driven versus cyclical. Lehman was a drawn-out cyclical problem, and those type of problems take a lot longer to fix. And here's the most important takeaway, because let's think of the trade. So when you look at the 2s, 10s curve, and you look at fiscal policy coming in, $2 trillion of fiscal spending in this new bill, a little bit more, $2 trillion, plus $3 to $4 trillion of lending power, that where the Federal Reserve for the first time is working with Treasury. They're backstopping a leveraged, what's called an SPV, special purpose vehicle, which is levered. So they can take, several hundred billion and lever it up to $2-3 trillion on on the Fed side. So you've net, you've got anywhere between 2 to 6 trillion of support here. And when that curve steepens, the twos, tens, and you get a fiscal, the sector that outperforms all the others is the Russell 2000, the IWM. And whenever there's a fiscal boost, when Trump was elected, look at the spectacular run in the Russell in that period. And the Russell, I think, is going to destroy the S&P the next couple of years. Remember, the new Harvey Weinstein in America are stock buybacks. And stock buybacks were the most beloved creature in markets, and now they're going to be a toxic, just the society is going to just get, there's so much attention on these stock buybacks, and the S&P is traded at a very high multiple premium to the IWM, to European equities, to emerging markets. So there's been this incredible three-handle premium in the S&P 500 because of that $5 to $6 trillion of buybacks the last 10 years. Remember, Wall Street's companies, or companies in the S&P, they sold about 10 trillion of bonds since Lehman, 10 trillion of bonds, and they took 6 trillion of that and bought back a lot of stock. And there's going to be a lot of pushback on that going forward. So you have to think, we're in a new regime. Sectors like the Russell, which do great in a fiscal spending boost, they do great when the 2-10 curve is steepening, which it is now. And we can show you that at the Bear Traps report. You're going to have a double barrel type events are going to move capital out of the S&P into global equities, into the Russell 2000, which is more value equities. And that's what we see the next, say, 24 months.
Very interesting. And we've seen already, Lair, a significant outperformance and bets by big institutions exactly the way you're saying in the IWM, the Russell 2000 folks, that ETF. Just to throw my 2 cents in, Lair, I agree with that assessment that an event-driven rather than an economic-driven sell-off, I think it is different. And I would also say that, or I would posit that I can go after, high frequency and algo trading all day long. But instead, let me just recognize that there's 70 some odd percent of the market, somewhere between 70 and 80% of what trades in the market right now is algo, high frequency, and the like. In other words, programs that were written by men and women, but not executed by men and women. These are, speed of light almost trading vehicles. And so that leaves 20% of the volumes that we see, Lair, somewhere between 20 and 30% of the volumes we see could be everybody from a hedge fund that doesn't employ that to pensions and endowments and individual investors. And so I would say that the speed of the recovery is also going to be different because of that. Because when we crashed in 08, we didn't have nearly the same percentage. I think we were just breaking into the 30% range back then of algo and high frequency trading. And now, like I say, it's double that, maybe even not triple, but it's definitely more than double what it was in the 07 through 08 timeframe. So I think that the timeframe of a recovery, given the right set of circumstances, we all know that the cases of COVID-19 need to plateau in the US. Hopefully we're seeing that in the next week or so, Lair. That doesn't mean we all go back to work. I realize that. But if we do start seeing that plateauing, Larry, then I think the recovery can be much faster. I don't think it's 398 days. I don't think it's 1,022 days, even though investor emotion and sentiment are going to be, let me hold off here. I don't want to do this, and blah, 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 because they got carved up pretty good in this drop. But again, they're a small minority of what's actually in the markets. It's kind of the opposite, Larry, of when we say, well, of GDP, the consumer is 70% of GDP, right? The
That's right.
consumer, you and I going out and spending, that's why it's so bad when we hunker down at home and we're only buying stuff on Amazon, Target, Walmart, Best Buy, anybody that'll deliver stuff to us. But you flip that around and say, okay, but when we have 70% that is driven by high frequency algorithmic trading, pairs trading, all the rest, I think we can be much faster. And the minority rather than the majority of trade is not retail. It's a minority of trade is retail. So even if psychologically they're damaged, they're not going to influence the market nearly as much as those big, fast institutional algorithms, if you will.
Yeah, I agree. It's not going to be anywhere near as long as the Lehman drawdown, the time that it took. And one important thing, if you're managing risk and trading, you want to build a position in high quality stocks during this type of crisis. And we have a number of indicators in terms of measuring capitulation. They all gave strong buy signals last week. One of them is the percentage of stocks above their 200-day moving average got down to 3%. That was that Lehman type levels last week. And then 52-week highs. We had 52-week lows. We had close to 1,800 stocks that were at 52-week lows in the New York Stock Exchange. That once again, you go back 30, 40, 50 years, is one of the highest readings ever. So both of those things are give buy signals. And they also tell you that the seller exhaustion last week was so severe that this rally, we may retest the lows, but most likely this rally is sustainable for at least a couple of months. But getting back to the algorithms, one thing we've done is talk to a lot of these programmers and these hedge funds and these quants, and what they do is kind of simple. They have these brilliant programmers and they give them a number of, like, the 200-day moving average now. For a lot of times, when I was younger in the business, if a stock broke the 200-day moving average, the sell-off was, might be 2, 3, 4, 5 weeks. Now all the programs are written for that mark. So that's why you see this accelerated selling, because all of the programming that's been written into the code, when we had such a violation of these numbers, the quants all came in and were selling aggressively. And on the retracement, this is very important. So the retracement, the 50% retracement, as well as the 36%, those are numbers that you really want to watch carefully over the next couple of weeks and months, because that's where the algos, they look back over the last 100 years, and on the 50% retracement and the 36% retracement, that's where a lot of the selling comes back in. It's programmed to come back in. So you want to watch for those numbers. And yesterday we got right near a very important retracement level, and sure enough, the sellers came in. They were almost like, well, my point is the selling is programmed to sell. And also 2,800 in the S&P. I want to, right now, for at least the next month, I want to be buying in the 1,900 to 2,200 range, building a position, your favorite stocks, 1,900 to say 2,300. We might have another shot at that. And then you want to lighten up between 2,600 to 2,800. 2,800, the market has spent an incredible amount of days there the last 5 years. And so there's a lot of supply there. Remember one thing, all of that buy the dip crowd, that entire buy the dip crowd that crushed it 2012, 13, 14, 15, 2018, 19, 20, the entire group is losing money. And what happens is when you have these vicious sell-offs and you get back to certain levels like 2,800, they want to get even and get out. And that's why it's so difficult to get through these levels. It's not going to be a Lehman type 3-year situation, but yeah, it's probably like 6, 9 months to a year to get back up above that 2,800 level.
Well, Larry, I can't thank you enough. Is there anything else? I've got your the bear report up on the screen now, so investors can see exactly how they can follow you and so forth. As I've said, folks, he is at Convert Bond as well on Twitter, and some really smart folks follow what Larry McDonald has to say. So make sure that you do check it out, and maybe you want to be one of those 400 folks that are on his calls when they make them during the week. So Larry, anything else you want to say before we wrap it up today?
Well, I just say one of my favorite quotes, J.P. Morgan, 1907, said, "There's nothing in this world which will so violently distort a man's judgment more than the sight of his neighbor getting rich." and and that's why what you want to do is you want to buy deep capitulation. You want to measure and quantify that capitulation. You want to build position into deep capitulation sell-offs like we had in 2011, 2016, 2008, and now 2020. As Seth Klarman says, buying right never feels good. Buying right should never feel good. If you're really making a good purchase, it's got to feel bad. And you want to take advantage of capitulation, build a position in your favorite companies, and then sell slowly over time. And when you see your neighbor getting rich, that's the warning sign to really take some money off the table.
Cool. Hey, Larry, thank you so much for sharing this on a Friday. Really appreciate it, my friend.
Thanks, John. Great to see you.
Great to see you.
Look forward to seeing you in Manhattan, and we'll go out to our favorite restaurant for a change.
Yeah, I look forward to that too. Thank you, Larry.
Okay. Thanks,
Folks,
John.
that's Larry McDonald. The Bear Report is how you can follow him as far as seeing the work that he does. And of course, Twitter at Convert Bond. Thank you, Larry. Have a great
Thanks,
weekend.
Okay.
My best to your significant other.
Here's to health.
Here's to that. Thank